Welcome to the deep dive. Today, we're tackling something pretty major that just hit the markets, these new Trump tariffs.
That's right. A big shakeup. We're going to unpack, the immediate fallout and what it might mean long term.
Yeah, especially for the global economy, Japan, and, of course, the stock and crypto markets.
And we're digging into this comprehensive report, Fag, sure, 4.3.pdf to guide us.
So the mission for you, our listener.
Simple, really. Get a clear, concise handle on this whole thing, what happened, how long it might last, and maybe some ways to think about navigating it.
Without getting totally overwhelmed by all the noise.
Exactly. No jargon overload.
Yeah.
Let's just dive into this tariff shock.
Okay, so it all kicked off April 2nd, U.S. time. Then President Trump announced these reciprocal tariffs.
And reciprocal is the key word there. This wasn't just a minor adjustment.
No, definitely not. The news just, boom, sent shockwaves everywhere. Instantly.
Right. And the specifics are, well, quite something. You've got this baseline 10% tariff on pretty much all imports.
But not the USMCA countries. Mexico, Canada.
That's correct. Yeah, they were the main exception. But then, on top of that baseline, you had targeted tariffs.
For countries with big trade surpluses with the U.S., right? About 60 of them.
Exactly. And the numbers were significant.
China got hit with 34%?
34%. The EU, 20%. And Japan, 24%.
Okay, that 24% for Japan. The report had an interesting angle on that.
It did. It mentioned it's based on a U.S. calculation. They're basically saying Japan's non-tariff barriers, hidden rules and stuff, they create an effective burden of like 46% on U.S. goods.
So the 24% is presented as, what, meeting halfway almost? Leveling the field?
Kind of, yeah.
Yeah.
That seems to be the framing from the U.S. side. And then there was more.
Oh, yeah, the cars. A separate 25% tariff on all imported automobiles.
And the analysis we're looking at suggests that alone could knock, 0.1%, 0.2% off Japan's GDP?
Ouch. So the global reaction, immediate risk off.
Totally. People immediately started calling it a de facto trade war. You just saw money flee from anything considered risky.
And the U.S. stock markets, they just cratered the next day, April 3rd.
Oh, absolutely plummeted. The S&P 500 dropped 4.84%, biggest fall since June 2020.
Wow, and the Dow?
Down 3.98%. That's 1,679 points. And then NASDAQ, even worse, down almost 6%.
Yeah.
5.97%.
Over 1,000 points on the NASDAQ.
Yeah, 1,050 points. For all three indexes, it was the worst day since the early COVID shock in 2020.
Just incredible, the amount of value wiped out.
The report puts a number on it. Around $2 trillion in market cap gone from the S&P 500 companies in one day.
$2 trillion. It's hard to even grasp.
And the VIX, the fear index,
It's shot up, I bet.
spiked towards 40,
Yeah.
settled in the high 30s. Just shows you the sheer panic, really.
But it didn't stop there, did it? China responded.
Nope. As expected, China announced retaliation on April 4th.
What did they do?
A uniform 34% additional tariff on all U.S. products.
Across the board. Same level as the U.S. tariff on them.
Pretty much, yeah.
Yeah.
34%, set to kick in April 10th.
And that just fueled the fire, right?
Yeah.
Fears of escalation.
Exactly. Tit for tat. The U.S. market kept falling. You saw big tech names like NVIDIA, AMD, Broadcom. They opened down another 4-6% on the 4th.
Just no bottom in sight at that point.
Not immediately, no. And then Japan's turn.
April 4th for them, too.
Yep. The Nikkei 225 plunged 2.75%. That's 955 yen.
Fell below 34,000.
Yeah. First time in about 8 months. At one point during the day, it was down almost 1,500 yen.
Wow. And most stocks were down.
Nearly 90% on the TSE prime market. Trading volume went through the roof, highest for the year, over 6.8 trillion yen.
Classic flight to safety then. Yen strengthened.
Textbook. Yen hit a 6-month high against the dollar. Briefly went below 145.
Okay, let's break down the sectors. U.S. first.
Sure.
Tech and consumer stuff got hammered.
Definitely. Anything with a big overseas supply chain, especially China. Apple down over 9%.
Why so much for Apple?
Concerns about that potential total tariff hitting 54% on goods made in China.
Right, and Amazon Meta.
Amazon down 6.6%, Meta 7%. Dell took a massive hit, down 19%.
19%? Wow.
Yeah. Nike, Lululemon, down around 10%. The semiconductor index, the SOX, also dropped about 10%.
Was it just tech and consumer?
No, pretty widespread. Autos like GM, Ford were down, financials too. The KBW Bank Index fell almost 10%.
Citi, Bank of America?
Both down over 10%. The report basically said commentary was like no one escaped in the U.S. sell-off.
Rough day. And Japan? Similar pattern. Exporters, tech.
Very similar. Export-focused companies and tech stocks led the declines. 30 out of the 33 TSE sectors fell.
These semiconductor stocks there too.
Hit hard. Laser Tech, Advantest, hit year-to-date lows.
Any other notable areas?
Banks sold off sharply, actually triggered a circuit breaker on the 2PS Banks Index futures.
A circuit breaker, so they had to pause trading.
Yeah, temporarily halted to stop the panic selling in bank shares. Shows how severe it was for them. Non-ferrous metals, oil stocks also down.
Anything hold up okay?
Relatively speaking, yeah. Some domestic-focused and defensive names, like KDDI, the telco, Odaku Electric Railway, Notori, the furniture retailer.
Interesting. What about Toyota? Big exporter.
It was down, but actually less than some other cyclical stocks. The report suggested maybe there were hopes for U.S.-Japan negotiations helping them specifically.
Gotcha. So investor sentiment just flipped.
Oh, completely.
Yeah.
Pessimism surge. You suddenly heard recession and even Lehman-level shock being thrown around.
And those fear optimism gauges.
Deep into fear territory, according to the report. And predictably, people rushed into safe havens.
U.S. Treasuries, gold, the yen.
All saw inflows. The 10-year Treasury yield even dipped under 4% for a bit.
And crypto. What happened there? Bitcoin?
Took a hit, too. Bitcoin fell over 5%, dropped to around $80,000 temporarily.
So much for the digital gold safe haven theory, then.
Well, it's certainly disappointed on that front this time. Major altcoins like Ethereum, Solana, XRP, they're down even more, maybe 10% weekly.
Okay, so yeah, the report nails it. Tariff shock. Stocks down, crypto down, volatility way up.
Which brings us to the big question.
Is this just a quick dip or the start of something longer, something worse?
That's what everyone's trying to figure out. Short term, thinking weeks, maybe a month. It really hinges on policy responses, negotiations.
Between the U.S. and trading partner.
Exactly. And there's that little gap, right? The 10% tariff hit April 5th. The additional ones are slated for April 9th.
So a window for talks.
Potentially, yeah. A small one. And the report notes that allies like Japan and the EU are protesting, seeking talks.
So a key thing to watch is compromises. Exemptions.
Precisely.
Yeah.
If we see some flexibility, maybe some tariffs get eased or delayed, that could spark a rebound.
Like in the 2019 U.S.-China situation.
Yeah, the report draws that parallel. Some tariffs were postponed then, and the market did recover. So there's a precedent if things de-escalate.
But the downside risks are still there, big time.
Absolutely. Retaliation from the EU, Japan, that could easily spiral.
Into that full-blown trade war scenario.
And just tough talk from the U.S. side could keep investors nervous, keep volatility high.
So expect more bumpy rides in the immediate future.
Very likely. High volatility, market searching for a floor. That seems the most probable path near term.
Technically speaking, the indices broke key lows, year-to-date lows.
They did. Yeah. Which technically could set up a bounce. But
the selling pressure is probably still strong underneath.
Exactly. So nervous trading, likely to continue until we get clearer news on negotiations or something else significant.
Okay, let's shift focus. Midterm, say the next 3 to 6 months. What are the possibilities?
The report lays out a few scenarios. First, the optimistic one, early resolution.
Negotiations work out?
Yeah, maybe a compromise by early summer. Leads to tariffs being partly withdrawn or eased.
And the market reaction.
Could be a strong recovery by summer. The report again points to 2018 U.S.-China dispute. A partial deal then led to a rapid market recovery. S&P was up over 31% in 2019.
So if tariffs get cut or there's currency coordination, maybe a good second half of the year.
That's the optimistic possibility, yes.
Okay, scenario 2.
They call it the partial protraction scenario. Trade friction kind of grinds on, even if there's some easing.
Why would it drag on?
Well, Trump might stick to his guns, election promises, his base. So tariffs stay mostly in place.
And the economic impact?
It would gradually bite harder. You'd see it in corporate earnings, economic data, a clearer slowdown after the summer.
The report mentioned potential GDP hits.
Yeah, for Japan, maybe a 0.7, 0.8% reduction in real GDP raises the recession risk there significantly.
And for the U.S.?
Could cool down consumer spending. Companies earning less, inflation from tariffs. It adds up.
But this scenario also includes potential support measures.
Right. Central banks, governments stepping in. There's already market chatter about the Fed maybe cutting rates, maybe the BOJ holding off on more hikes.
Which could cushion the stock market fall.
Could provide some support, yeah. The thinking here is the market probably bottoms out within that 3-6 month window, then a slow, gradual recovery.
Like the 78 days it took the U.S. market to recover in 2018.
Something like that, yeah. That's the historical reference they use.
Okay, and the third scenario, the pessimistic one.
Long-term slump, maybe even recession. This is if tariffs escalate further, things really spiral downwards globally.
The report mentions Smoot-Hawley, the Great Depression Tariff Act.
It did. A sobering reminder of how bad trade wars can get.
What's the main worry in this scenario?
That U.S. tariffs become permanent, maybe even expand, companies forced into huge, costly supply chain restructuring.
Leading to disruptions, higher costs, less production.
Exactly. Which then hits corporate profits, employment, potentially leading to a proper bear market.
The Russell 2000 is already there, apparently.
The report noted that, small caps are already in a bear market, but
maybe not as bad as Lehman.
the thinking is the financial system is maybe less fragile now, and governments, central banks have more room to act, stimulus-wise.
So even in the bad scenario, it's maybe more like sharp fall, policy response, then recovery. Less risk of total stagnation like '08 or 2020.
That seems to be the general expectation, yes. Less risk of a prolonged freeze-up.
There was also that Nomura analysis mentioned about public pressure in the U.S.
Right. Nomura suggested that if prices rise and the economy slows noticeably in the U.S., public opinion and businesses could push for tariff changes.
But that might take a while.
They reckon it could take over 6 months for that pressure to build and have an effect.
Okay. So pulling it all together for the midterm, gradual recovery seems the most likely path after the initial shock.
That appears to be the consensus view, yeah. History suggests these shocks often lead to an adjustment period, then rebound.
Like Brexit recovery or post-2018, post-2020 recoveries with policy help.
Those are the examples cited, yes. Monetary easing, fiscal stimulus playing key roles.
And maybe the Trump administration itself pivots if the economy really suffers.
That's also a possibility mentioned. Political pressure from a falling stock market is, hard to ignore indefinitely.
Right. So summarizing the outlook. Short-term pain likely continues, volatility stays high, but a recovery within, say, 6 months is seen as probable due to policy adjustments, adaptation.
Seems to be the base case. But, crucially,
Need to keep the optimistic and pessimistic scenarios in mind. Stay flexible.
absolutely. Monitor things closely. Be ready to adapt.
Okay. So let's talk takeaways. What should listeners be thinking about, maybe doing right now? Actionable insights.
First thing, maybe the most important, avoid panic selling. Try to keep a long-term view.
Easier said than done sometimes, but history shows markets recover, right?
Overwhelmingly, yes. Corrections happen. Use this maybe as a chance to review your portfolio, your asset allocation.
And downturns can be buying opportunities.
They can, if the underlying value is still there, if the companies are fundamentally sound long-term.
Okay. Second point.
Diversification and dollar cost averaging, more important than ever now.
Spread the risk across asset classes, regions, sectors.
Exactly. Maybe look at things less correlated to stocks like bonds, maybe some gold, defensive stocks.
And keep investing regularly, like in a 401k or similar.
Generally, yes. Dollar cost averaging. You buy more units when prices are low, lowers your average cost over time. Don't try to time the bottom perfectly.
Makes sense. What about specific areas to invest in? Any themes?
The report suggests selectively looking at promising themes that got beaten down. Semiconductors, for instance.
Because long-term demand from AI, IoT, EVs is still there.
Precisely. The recent drop might be more about short-term tariff worries than fundamentals. Could be a decent time to look at quality semi-stocks.
You mentioned something interesting earlier, a decoupling in the supply chain, creating niche opportunities.
Yeah, the report hinted at that, like advanced packaging outside traditional areas, a second-order effect, but something to maybe watch.
Okay. What else? AI and tech generally.
Long-term growth trends still look intact. Mega-cap tech fell hard, but their core businesses are often still very strong. AI, digital transformation enablers, still relevant.
Renewable energy, EVs.
Same logic. Big long-term tailwinds from decarbonization, policy support. Tariffs might create temporary cost issues, but perhaps buying opportunities in clean energy ETFs or related stocks.
What about playing defense short term?
Could make sense.
Yeah.
Maybe temporarily shift a bit more into high dividend stocks, consumer staples, utilities, healthcare, food, things people need regardless for stability.
And look beyond the U.S. and Japan.
Definitely worth considering. Markets may be less impacted by U.S. tariffs. India, Southeast Asia are mentioned as possibilities.
Gold, crypto.
Consider them as part of a diversified strategy, sure. But always be mindful of the volatility. They aren't magic bullets.
Crucial point. Cash.
Yes. Keep some powder dry. Having liquid assets is key. Avoids forced selling if you need money. Lets you potentially buy more if markets dip further.
How much cash? Any guideline?
The report suggests maybe 10–20% of your portfolio in cash or short-term government bonds. Something easily accessible.
And if you do buy the dips, average down. Do it carefully.
Yes. Disciplined approach. Deploy capital in stages, not all at once chasing a falling knife.
Okay. Final takeaway seems to be stay informed, stay adaptable.
Absolutely paramount. Watch the news, government statements, central banks, company earnings. Be ready to adjust your strategy.
Hedging is mentioned too, but maybe for more experienced folks.
Generally, yeah. For most people, sticking to the basics, diversification, long-term view, discipline is probably the best approach.
You know, the report frames these disruptions in an interesting way, not just threats.
But also as catalysts, right? Potential catalysts for long-term change. Periods of uncertainty, while unsettling, often do pave the way for new economic realities.
And new investment opportunities down the line.
Exactly, which leads us nicely into that final thought.
Right, so here's something for you to chew on. This tariff shock has created a lot of immediate uncertainty, no doubt. But history really does suggest these disruptions often set the stage for something new.
New economic landscapes, new opportunities.
So the question is, what currently overlooked sectors, or maybe even new global alliances, might actually do well in a world where the U.S. is focused on this idea of reciprocal trade?
And more importantly for you, how can you position yourself strategically to maybe benefit from those long-term shifts that could be coming?
Something to think about. Until our next deep dive.